Hello everyone and welcome back to the Velocity channel where we are your bridge to financial freedom. Today we've got a doozy for you, and it's going to be something that you'll need to refer to a time and time again, because you're not going to believe how simple velocity banking can be, even if you don't want to put all of your income inside of a line of credit. We're going to actually give you a hybrid scenario so that you can utilize this in any shape or form that you find yourself in, fighting that loan, fighting that mortgage debt, fighting that student loan. We're going to show you how to do this hybrid method of line of credit and checking account if you want to keep most of your money inside of a checking account and just do a little bit towards your line of credit. We're going to show you how powerful that can be. But before we do that, like, share, and subscribe so that people all around the world can know about the velocity banking method. And look, if you need an easier way to do this, if you don't want to do the calculations, you don't want to see me, do these videos, listen, there's an automated velocity banking system that we have and that we can connect you with. Just call me up. I'll go over your scenario and see if you qualify. All right, listen, are you ready? Let's get into this. So, we love utilizing the $5,000 each month because that's the national average that people make in the United States of America. $5,000 each month, $60,000 each year. But what if you didn't want to put all of that money inside of a line of credit? Well, listen, velocity banking can still be powerful for you in the following way. All right. So let's say, listen, I still want to use my checking. I still want to use my savings account, right? My black hole account, CJ. So what if I just want to put $500 inside of my line of credit? I just have a $500 line of credit. What can velocity banking do for me now? I don't know if you heard your sign, but listen, we heard you. All right. Watch this. $5,000. Fine. You can split it up and put $4,500 inside of your line of credit, and then you can put $4,500 inside of your checking account, and then $500 in your line of credit. But what if you have something to tackle, and that is a $5,000 loan at 6%? Well, your minimum monthly payment, that company is saying, is going to be $300. Which, wait a minute, isn't that just the interest? No, CJ, it's all in how they calculate it. So it could be worse. What? Man, hey, but this is what we're going to do with this $500 and with the $4,500. You see, what I didn't say is that this person has already been paying $300 each month, right? And that's already within their expenses. Okay, so they already have this mapped out in their mind. This is a brand new loan. They haven't paid anything on this yet, but they want to have a plan. So this is your plan, all right? You're going to take this $500 here from your line of credit, and you know what you're going to do? You're going to place it towards this principal. Now, what does that do to the principal? What does that do to the interest when you do that? That's right. It decreases the interest. It decreases the amount that you're giving to the bank. That's what interest is. It decreases that. Why? Because the principal is being decreased. And so that's what you do with your line of credit. This is how it's supposed to be utilized. Okay? Do you see how you're turning your line of credit to an asset instead of a liability? Because you're using it to decrease the interest towards the bank, and you're increasing the interest towards you. Let's go forward. Now, you already know that the minimum monthly payment is going to be $300 each month. So guess what? You're paying that $300 and it's already mapped out. That's money allocation plan. It's already mapped out in your finances. That means it's already a part of your expenses. So you have the $500 going towards this loan. You also have the $300 each month going towards this loan as well. So that's a total of $800. But this $800 is not equal. Do you know why? Because $500 is going towards the principal, while that $300 is just making that minimum monthly payment. But what do the banks consider this? Don't they consider that a payment? Don't they consider, you know what? This guy's already made a payment. Why is he paying over? We are designating this $500 towards the principal. So we tell them that, okay? Because we know how to pay loans off now. But my question is, this $500, didn't we just add on another debt? Or did we? Because what happens when $5,000 comes back in again? Well, CJ, you pay your credit card. I pay my credit card? I pay my line of credit? Or do I transfer part of this $5,000 inside of my line of credit? The reason why I say transfer is because you can use this $500 again. Do you see how, just like this is a checking account, you can also use this as a checking account? And what if this was unsecured? So this is someone else's money anyway, that you're just paying and borrowing. Paying and borrowing. Huh? Do you see that? You see how you paid yourself? So look, if we're looking at this loan as something that we're going to be in for life because we're paying the $300 each month, then we're looking at it in a non-velocity banking way. But if we utilize our line of credit, even if it's just a little bit, look at how powerful that is. We're going to be paying this loan off in what, 10 months? Somebody do the math. 10 months or less than 10 months. And you didn't even have to drain your checking account. You didn't even have to go into more debt. Because is that a debt? Or is that an asset? Look at what you're doing. I mean, this is an asset, folks. You're beating up the principal each and every month. Huh? Because next month, it's going to be $4,500. Then the month after that, it's going to be $4,000. And oh, by the way, guess what? It's coming down even more because you're paying the $300 each month. And so what happens after you're done paying that off in about 10 months? Then you have an extra plus $300 that you can put towards yourself, that you can put towards your assets, that you can put towards paper stocks, real estate investments. I mean, there's all types of things that you can do, education, to improve your human capital, right? This is where wealth is created right here. And so are you ready for me to do an overview? Let's do it again, okay? $5,000, you don't want to use the line of credit method as much, all right? You don't have to. You can put $4,500 inside of your checking account. You can put $500 inside of your line of credit. And then with this loan that you got, I don't know what for. Maybe you want a bouncy house or something. You got a bouncy house business. That's good, right? They gave it to you 6%. How are we going to pay it down? We're going to take from our line of credit $500. We're going to put that towards the principal. Because when the principal goes down, the interest goes down. Isn't that interesting, right? And look, you're already paying from your checking account $300 each month anyway, all right? And so each month, when this gets replenished, this is getting decimated. But could that have been possible without velocity banking? Could that have been possible without knowing how to allocate your finances? You tell me. Now look, can you do the same with a checking account? You sure can. But no one's going to say, listen, we love what you're doing with your checking account. I mean, look at the good, you're a good steward, all right? So we're going to give you $5,000 extra dollars. We're going to give you $500 extra dollars. We're going to give you, they don't do that. Not for the checking and savings accounts, but they do that for lines of credit, for credit cards. All right, they do that. and we want you to experience. We want you to be a victim of the line of credit increase. All right, folks, man, there's just so much more. And I want you to join me in my class that we have as well. And man, we need to get on the phone and we need to talk to see how we can help you out with our automated velocity banking system. God bless and have a good one.